Hey everyone, wanted to get this very brief video out on a concept that will be maybe going a little bit more in depth on when we do the re-recording of the GG course here in the next couple of weeks for the annual subscribers to GG alerts. Anyway, you've seen me recommending spreads recently in the last couple of months anyway, on certain situations, especially on the call side, when we have actually high IV environments, and we definitely have a high IV environment. So I wanted to give you maybe a little bit more description here of why I'm doing it and how this is all centered around. So we're gonna talk about Vega neutral strategies very briefly. Green Goose Trader, we're not an investment advisory service. We're not registered investment advisors, and don't necessarily purport to tell you which securities you should buy or sell for yourselves. You need to check with your licensed financial advisor, tax advisor, to determine the suitability of any type of trade that we talk about here. This is all educational stuff, and as you know, there is definitely a high degree of risk in trading. Anyway, as you know, Green Goose and also its other systems are kind of centered around gaps, especially Green Goose. And this is what I'm going to be talking about here today in this short video. It's really all about taking advantage of the overnight gaps. So what we do is we obviously determine the direction it's going to gap, and we put in either a bullish or bearish play on our ETFs or stocks of concern, and we close those out the next morning. In some cases, we do other things, like with the Green Goose system, where we do other things, like reversion of the mean, filling the gap and stuff. But really, Green Goose is all about the overnight gap. It's very much based on where I live, and you guys can take advantage if you have similar situations as me, as far as not being present during the market and really only being able to be present at the end of the day and at the beginning of the day in the U.S. stock market. I'm sleeping during market hours because I live in Asia. Anyway, so it's a gap system. But we have a current market environment that is, let's just call it challenging. We've been in a downtrend with very, very high volatility, with a lot of whipsaw, meaning things go up and down really huge amounts. I mean, we even had, 2-3 gaps, 3 days, more than 2% in the last week. It's been pretty tough, okay, if you're not in the right direction with the plays that you're in. But really what's going on is that we're talking about IV. Okay, so on the right chart here, I've got the VIX right here. That's the VIX, which is, it's for volatility. And what I have here is I got the SPY over here on this side, SPY. Okay, so downward moves, they're always accompanied by IV rush, meaning the IV goes up. It pushes the premium up for if we're in puts, we're in the right direction. Upward moves, unfortunately, are accompanied by IV crush, meaning that the IV goes down, VIX goes down. You can see, we stabilized here, right here, and the price of the stock went up, but at the same time, with stabilization, the price going up, the VIX and also IV of our options went down and reduces premium. And in a lot of cases, it can actually result in actually losses, even if we get the direction right. So what we have going on right now is we've got a lot of volatility risk with any system that you run, especially if it goes into a bullish type of play. So high implied volatility results in options with higher premium, which means it can go down. So the general rule of thumb is the price of the stock goes up, IV goes down and reduces options premium. Takeaway for GG, it reduces our profit on smaller gaps, and sometimes even results in either break evens or even losses if we're right. But if the stock price goes down and we're in puts, obviously IV goes up and juices the option premium. That's really good for the GG system because it increases our profit, it juices the premium. So the option of concern here, or the Greek of concern here, is actually Vega. And what Vega is, it corresponds with the price factor determines the Black-Scholes model for volatility. It doesn't represent the sensitivity of the price of the option to volatility. I'm sorry, it represents the sensitivity of the price of the option to volatility, but not the volatility itself. What we would strive to do to try to eliminate that volatility risk is to make Vega neutral. Okay, so a Vega neutral strategy can be used when volatility presents that risk to our profits, and we know that there's a risk to our profits if we are in calls right here. So we know that there's an additional risk because of volatility. So anyway, the Vega neutral strategy for GG is actually quite simple. I don't want to get into huge, like, oh, you got to do this, got to do here the rules, but it's really as simple as this. Okay, first of all, it's going to be a spread. Okay, you got to have spread capability in your account to be able to do it. I highly recommend it. We're not day trading this stuff, so you use an account that allows you to do spreads, and it's as simple as buying an in-the-money call and selling it out of the money call. Okay, so the in-the-money call has a positive Vega right here, and the out of the money call has a negative Vega. So the way I like to use this type of strategy is, first of all, it's only for bullish entries. It's best used after a strong move down in the stock where IV is high, but likely to crush the following day if you do get your move back up. And then I really only like to use it when our entry day has an expiry of 2 days or less. So for EEM as an example, that would be on Wednesday or Thursday. Obviously, if you're in SPY or IWM with Wednesday expiries, you could do this Monday and Tuesday as well. But really, you need to have fewer days. The exit itself is less sensitive. GG at its core the last couple of years has been to exit at open the next morning to take advantage of that gap. But if the gap is actually more than the intrinsic value of the in the money call portion, and especially if it gaps over the out of the money call, that's really good. But you can hold it. You can hold it a little bit longer. I really love to hold these to expiry if the price of the stock is over the short leg of the call. Then I get full profit. But there is definitely a drawback, and the drawback is that the potential profit is lower. Okay, so if we get this massive $10 move in the stock, we can no longer get 500% ROI. We're really going to be limited to a lower ROI. Okay, so let me just give you an example. GG with SPY calls. I mean, if you're trading SPY, I personally do EEM and Apple and stuff. But if you were trading SPY, the 14th of June, which is I believe that was Tuesday, the direction was calls. Okay, so but what we had is we had a really strong move down, and this is a chart of the IV, and we need to focus in on the red line, which is the options that are basically the short-term options. So you see the IV is really, really high. And when it gets up here, what happens? It goes down. If the IV goes down, it actually, it reduces the profitability of the play if it does go down. Okay, so a straight call here has IV risk. Okay, so this would be like an example. We'd position size this to $500 or less. So you'd really only be able to get into one, which would cost $3.51 at the end of the day. Okay, and you can see the Vega here is 7.8. Okay, so this would be a 374. It's an at the money call. So what happens the next day? We did get our move up, right? And the end of the day, this particular, I don't know exactly what it was at the beginning of the day, probably a little bit less than this. But at the end of the day, that particular call, which is expiring that day, was worth $115 profit, which is 32.8% ROI. Maybe it was a little bit less, maybe right around the same at the beginning of the day, but the IV went down. Okay, so if we compare it to the Vega neutral strategy, Okay, so remember, keep this in mind that we had a 374 call, and you go to the Vega neutral strategy, still the same IV environment, and we're going to say, okay, I'm going to buy, instead of a 374 call, which is at the money, I'm going to buy a 373 call, which is in the money. You can see the price here is 373.92 at the end of the day, and we buy an in the money call, 373, and we sell a 374 call. Okay, and it's going to cost us 49 cents. Our max profit is 51 cents. So we can really only get 100% ROI. But what you note here is the Vega. Okay, so the Vega is positive 7.8 on the long call and negative 7.8 on the short call. So we are now in a Vega neutral type of position where any change in volatility up or down is not going to affect the trade. Okay, so that is what a Vega neutral strategy is. It's buying an in the money call, and it's selling an out of the money call, so that your Vega, combined Vega of the two, are zero, okay, or as close to zero as possible. You can do the same thing with puts, but I'd rather take advantage of volatility with puts. Okay, so the result of the next day, which actually, when was it today? Wednesday, was that it actually expired above the short strike, so you have full profit at 51 cents. Now, the one thing to note here is that for the equal number of $350 risk of just the straight call, you could get, 7 of these. So 7 times 50, 51, equals 357 profit. Okay, so that compares quite favorably to the straight call, and the reason we're able to do that is because this was a Vega neutral type of strategy. So I wanted to get this out there because there's definitely a method to my madness when I talk about getting into spreads. We start getting into a little bit more advanced concepts here, but this is the reason. The reason is to be able to manage the IV. So hopefully this is of use. I'm going to post this into the GG alerts. This is actually going to go to everyone. So I'm hoping that people like what they see here and they can get into the premium side of the alert service. We've already got a lot of people on here, but always the more the merrier, because it encourages more comments and more learning from everyone. Thanks much, everyone.